let's jump right into this explainer, because today we're looking at a claim that honestly sounds totally impossible. We're talking about turning a simple $100 a month into well over $300,000. And the best part? We're doing it without trying to magically pick the next Amazon or, betting the farm on Tesla. We're unpacking a concept that is quietly responsible for building massive fortunes, yet it really doesn't require any special financial genius. It just requires a little bit of patience.
Here is our roadmap for today. We'll hit the wealth building secret, how compound interest actually works, the value of time, the power of $100, the rule of 72, and finally, how to make compounding work for you.
All right, Section 1, the wealth building secret, turning those small amounts into massive wealth.
So the truth is, the real secret to wealth isn't finding some miracle investment. It's not about timing the market perfectly. It's really just about leveraging a very simple, very old mathematical concept. And the crazy thing is, the earlier you grasp this, the more insanely powerful it gets. We're talking about compound interest. Basically, it's when your money earns returns, and then here's the kicker, those returns start earning their own additional returns over time. It's this continuous cycle. Think of it exactly like a snowball rolling down a long hill. When you first pack it, it's tiny, right? But as you push it downhill, it picks up more snow. The bigger it gets, the more surface area it has, which means it picks up snow even faster as it goes.
Moving to Section 2, how compound interest works, the actual engine behind all this growth.
I love looking at the actual data here because this table brilliantly shows that engine in action. Let's say you invest an initial $1,000 and you earn an average 8% return. After year one, your $1,000 earns $80, leaving you with a totally new balance of $1,080. Now here is where the magic happens. Look at year two. Your starting amount isn't just your original $1,000 anymore, it's $1,080. So that 8% return is now calculated on that larger amount. Instead of making another $80, you make $86.40, bringing your total to almost $1,167. Your money is literally out there earning its own money.
And this compounding cycle is especially powerful when you use long-term retirement accounts, like a 401k or an IRA. It's a continuous loop. You invest, you earn returns, you reinvest those returns, and then you earn returns on those previous returns. You just rinse and repeat. You're basically allowing your accumulated growth to become the exact fuel that drives your future growth.
Section 3. The value of time. Why waiting is actually costing you.
Most people completely underestimate the single most important ingredient in this whole mathematical formula. Let's run a classic A/B test comparing two hypothetical investors, Sarah and John. So Sarah decides to start early. At age 25, she starts putting away $200 every single month. John, on the other hand, waits a full decade. He doesn't start until he's 35. Realizing he's kind of playing catch-up, John decides to invest $400 every month, literally twice as much out of his pocket as Sarah.
Now let's look at how this plays out on this timeline, going all the way to age 65 when they both retire. Even though John is dumping in double the cash month to month, Sarah has an incredible, mathematically unbeatable advantage. She has 10 extra years. Those additional years let her earlier investments generate returns, and then those returns generate more returns long before John even makes his first deposit. It just goes to show you don't necessarily need to invest crippling amounts of your paycheck. You just need to give your money the runway it needs to do its thing.
Section 4. The power of $100. The math behind a 40-year strategy.
Let's bring this right back to you with a super realistic example starting at age 25. Imagine you decide to invest just $100 a month. That's roughly $25 a week. Like what? A few coffees or maybe one takeout order? Assuming an 8% average return over 40 years, your account could grow to well over $300,000. But look at the breakdown on this donut chart. This is the best part. That smaller slice, that's what you personally put in over those 40 years, just 48 grand out of your own pocket. The massive remaining chunk, over $252,000, is entirely compound growth. Money that just grew out of the money you already invested.
And if you check out the exponential growth curve on this bar chart, you really see the acceleration. In year 10, the growth is pretty modest. The snowball is still small. But by year 25, it is accelerating rapidly. And by year 40, it shoots right past that $300,000 mark. Now, quick reality check. This is an illustration, right? Not a firm guarantee. Real markets don't just hand you a perfect 8% every single year. Markets go up, they go down, and things like taxes and fees will always affect your bottom line. But the overriding takeaway is absolutely huge. Small, consistent contributions turn into something massive over several decades.
Section 5. The Rule of 72, your compounding shortcut.
If you want a really cool mental shortcut to figure out how fast this growth can happen for your own portfolio, meet the rule of 72. It is beautifully simple. You just divide the number 72 by your expected annual return rate, and you get a rough estimate of how many years it'll take for your money to double. So look at the table. If you expect an 8% return, 72 divided by 8 is 9. Bam, your money doubles roughly every 9 years. And a more conservative setup at 6%, that'll take 12 years. More aggressive at 10%, about 7.2 years. Obviously, it's just a rough estimate, but it gives you such a great perspective on the sheer velocity of your money.
Finally, Section 6. Make compounding work, the 3 rules of wealth.
Okay, so we've seen the math, we've seen the charts. Let's open the playbook and look at how you actually put this into practice today. There are 3 straightforward principles. Step 1, start early. As we saw with Sarah, even tiny amounts become deeply significant with enough runway. Step 2, invest consistently. Honestly, the absolute easiest way to do this is to just automate it straight from your paycheck. If it's on autopilot, you don't need daily motivation, it just becomes an invisible habit. And step 3, think long-term. The stock market is going to drop sometimes, and yeah, it can be scary. But jumping in and out trying to time it, that just kills your long-term growth. Don't try to predict the market. Just give your investments the time they need to grow.
Building wealth really isn't just about having some massive 6-figure salary. It's about what you do with the money you actually do have, even if it's literally just 50 or $100. So here is your ultimate takeaway formula from this explainer. Money plus consistency plus time equals the power of compounding. Do not wait until you finally feel rich enough to start investing. The day to build the habit is today.
Because at the end of the day, when we're talking about compound growth, time is absolutely without a doubt your most valuable asset. The math is clear, the diagrams prove it, and the roadmap is right there in front of you. So, what are you going to do with your time?